This is Dr. Duru from Ahan Analytics with the Market Breadth. There were two major themes that dominated the trading in the market, in my mind. The first was the Federal Reserve, which delivered its statement on monetary policy. That's Jerome Powell right there from the Federal Reserve. They cut interest rates like the market wanted, but the big takeaway was that the bond market did not like it. Long-term bond yields went up, and now we are facing the exact same scenario from the last Federal Reserve cut when the bond market went higher in terms of rates, prices went down for bond markets and then weighed on the stock market. So what we are facing is yet another set of conditions that are topping out the market. And I'll go through the charts to show you what I mean. The second big theme was Oracle. Poor Oracle, right here, that's Oracle. Tumbled 11% or so post earnings and had some follow through selling on Friday. Basically, they try to tell the same story as before. Their backlog, I think, got even bigger. But now there's all this worry about Oracle and the spending commitments that it's made and whether the demand is going to come through. Anyway, all that to say is that the AI trade looks very tired, looks topped out, doesn't look like it will participate in any kind of year-end rally. And as a result, that too is going to weigh on the overall market. So we've got long-term bond yields going up in response to an interest rate cut from the Federal Reserve. And we have Oracle reminding people that maybe this AI trade is not everything that it's cracked up to be. And I will show some charts, just some few key charts to show that message. All right, so very basic agenda for the coming individual charts that caught my interest. Going to start with all the major indices that are in my universe and then look into the individual stocks. All right, let's take a look. And thanks for, of course, being here. Please share and like this content. Let the algorithm know what's up. And if you have any comments or questions, put them down below. And of course, subscribe to this channel if you want to get notified of future videos. All right, let's go. All right, so as always, I start with the percentage of stocks trading above their 50-day moving averages, what I like to call AT50 for above the 50. It is a measure of market breadth. And you can see here, this purple line is the primary downtrend that I've had an eye on. And earlier this week, boom, we had a nice breakout. I'll zoom right in here so you can see that. A great breakout. Downtrend is over. But here is where the tired AI trade is weighing on market breadth. I was really excited. I was about to get bullish on the market when this happened. And instead, now we're back right at that downtrend line. So it's holding a support. So there's still one last shred of hope that the year-end rally has begun. If this former downtrend line can hold a support and we rebound off of that, it's all good. All right, let's go into the indices as I switch out the index. We're going to try to make this one a quick one because I've basically laid out the story at the beginning. Here's the Fed rate cut. This was on Wednesday. The market, the S&P 500 eked out a gain. It was very positive of 0.7%. After an intraday sell-off, the S&P 500 eked out another gain, and that was despite Oracle losing 11% post-earnings. But now we have this big down day, 1.1%, and you can see we are capping out right at the last time the Fed cut rates. So this is what I am most cautious and wary about. And NASDAQ, similar story, but the NASDAQ didn't even test its all-time high before curving downwards, losing 1.7% today, and then hitting the 50-day moving average, which is that red line. And finally, we have IWM, the ETF of small caps, iShares Russell 2000 ETF. It had a great breakout all week long, new all-time highs, but then today's 1.53% loss for IWM makes it look like not maybe like topped out, but it looks like the momentum is ended for now. So really looking for a positive Monday or beginning to next week to get this year-end rally back on in progress. All right, let's dive into the individual stocks that caught my interest. Of course, we have to start with Oracle. This is the chart of Oracle. This is what I'm saying is the big warning for Oracle. I actually concluded earlier that once Oracle got below its former all-time high, that was bearish for the stock. It tried to hold the 200-day moving average, fell through that, fake rally into earnings, and then bam, 10.8% post-earnings loss. That's Oracle Corporation, ticker symbol ORCL. The irony, the huge irony is that ever since the stock, in September gained that monster 36%, on the big news about the OpenAI deal, it has never been the same. You could see it tried to hang in there, and then it's just been selling off. So typically you would think that being way down here is the market totally overreacting, given how big the news seemed to be earlier. So the way I interpret this is meaning that Oracle is particularly bearish, unfortunately. And this bearishness in Oracle is really weighing down on the AI trade. Broadcom, ticker symbol AVGO, lost 11.4% today on after reporting its earnings. Fortunately for Broadcom, its uptrend is still just barely holding at the 50-day moving average. Again, that's the red line. I'll zoom in so you can see it just barely closed below, but we can call this holding support for now. I didn't get all the news on Broadcom. It seems like, this is just an expensive stock that didn't quite meet up to expectations, and so it sold off, not to mention the weight in the AI trade. You can see the volume down here is really high. So I highly doubt Broadcom is going to recover in coming days. Then finally, we have NVIDIA. NVIDIA is interesting. It just snuck up on me that NVIDIA has become dead money. It did make this double top. I've talked about this before. This was back in October. You can see that double top is holding firm. But even more importantly, NVIDIA has gone essentially nowhere. And I'm drawing, you can follow my cursor here. It's gone essentially nowhere since, what is this, late July. It closed down today, 3.3%. And at, what is this, say $175. And that's kind of at the lower end of the range. So I'm not calling NVIDIA bearish, but it is dead money at this point. There is no trade here. I mean, if you're a bear on the AI trade, you would short here because NVIDIA very clearly failed right at this 50-day moving average resistance. And then, the semiconductors, VanEck Semiconductor ETF, ticker symbol SMH, basically is all about AI. And so this is a good way of testing just how strong the AI trade is. It sold off big time, 4.5%. Probably in sympathy with Broadcom, of course, but you can see that the 50-day moving average is still in place as support, so it's not bearish yet. Sorry, I should better say this. It's still bullish, but certainly losing ground like this on Friday is just not a good look. And just really quickly, I'm going to look at Micron, ticker symbol MU. Earnings are coming up, I think, next week. It fell in sympathy, 6.7%. It almost looks like a double top. I will be watching Micron very closely because I've been bullish on Micron for a while. I took profits on my trade, I think it was a week and a half ago. So keep an eye on Micron for earnings. Let's see if the AI trade can get back on the horse, as they say. And then Intel, I'm not going to go through all of my flags and labels here, but Intel Corporation, ticker symbol INTC, has been drifting down from its last peak, and now it's testing 50-day moving average. I've been watching this like a hawk because I want to get back into Intel for a trade. And so now I need to see this 50-day moving average line hold as support. Again, that's the red line there. Okay, that's the AI trade. On the flip side, the consumer-facing stocks did pretty well, whether they were rebounding from bad levels or just skyrocketing in an overall bullish trend. This is Abercrombie Fitch Company, ticker symbol ANF. Its big turnaround happened with this 37.5% post-earnings gain. Sorry, let me correct that really quickly. Post-earnings gain. And it has been just strong ever since. Yes, it drifted backward here. I've been watching this like a hawk. I've written about it. I won't go over the whole story for Abercrombie and Fitch right now, but this is my big buy signal right here. I forget the technical name of this. It's not quite a bullish engulfing move, or maybe you could call it that. And it has been rocketing for me very well for the last 4 days. Now, it is getting a little tired. You can see the wicks. Let's zoom in here. You can see how sellers are taking the stock down off of the intraday highs. So I am on alert, but you can see that Abercrombie & Fitch has a long way to go to really get back into any overall bullish form. It's still a broken stock, but I really like this rebound and recovery effort. Now, Dollar Tree, I wrote about this and talked about this in my last video. I was looking for any kind of pullback to buy into. It's worked out so far. The week started with Dollar Tree peeling back just 1.7%. I just went ahead and bought. I anticipated I'd have to buy into some more weakness, but it just turned right around. And this is what I call the no regret trade. Get in a little bit of shares. If it continues higher, at least you have a position. If it continues lower, then at least you get the chance to buy the stock that you want at a greater discount. It looks like the former case is in place where it's just going to keep on rolling higher. I wish I had a bit bigger position, but at least I have one. Dollar General has the exact same pattern. Shopify is kind of driving me crazy. Ticker symbol SHOP. I've been following this one very closely. I have a new position. It's a call spread. I think a 171.80 call spread. I think it expires in another week. I'm playing this breakout over this 50-day moving average line, and it has been just a very choppy experience. I thought this was a great day on Wednesday when it soared 5.3% directly off the 50-day moving average, but man, that line is acting like a magnet. I'm happy, though, it did rebound off of that level on Friday. So it is holding a support. I'm hoping that this momentum, this magnet, will loosen its grip on Shopify and it will launch higher. Okay. Also, consumer facing, you can consider the home builders. This is an important move because this is the time for the seasonal strength for home builders. And you could see Toll Brothers, ticker symbol TOL, dropped 2.4%, but it was even lower after earnings. And buyers stepped in and have almost not stopped buying the stock. The gap closed, and Toll Brothers is essentially right back to where it was a week or two ago. So this is positive. This is proof positive that the home builder trade is alive and well and kicking and ready to outperform the S&P 500 in this season. Let's take a look at ITB, which is the iShares US Home Construction ETF. The story here is that it's still in bearish territory. So yes, Toll Brothers had a great recovery. I think it's a sign of good things to come. But this bear market line, which represents 20% correction from the all-time high, is still in place. And it's still also acting like its own magnet. And I need to see ITB break out higher. So I have significant positions in various home builders, including ITB, so that I am very interested in this trade getting better. Uber Technologies, ticker symbol UBER. It had a big down day in sympathy, a 5.5% loss in sympathy with Lyft. Lyft's business update, which somehow disappointed investors. Now, I am encouraged that the selling stopped on a dime right here at the former low from the last time it broke down below its 200-day moving average, which is this blue line. But I am not encouraged by the fact that it stopped at resistance, and which is now this declining 50-day moving average. I'm trying to hold Uber for a little longer. We'll see what happens. If it breaks to a new low below this day, this was back on Wednesday, I'm going to have to just release it because, being below the 200-day moving average is just bearish overall, and it could confirm a topping pattern in Uber, and I don't want to hang on much longer than I have to. I'll just show you Lyft real quickly. Lyft is still in a relatively bullish position. It's pivoting around its 50-day moving average. You can see here it lost 6.7% after giving a presentation at the NASDAQ investor conference. I don't know. I read the news. It seemed all good to me. I think, again, this could be just a matter of expectations were too high for this conference, or maybe, of course, I may have missed some news. But let me peel back. You can see Lyft is in a pretty decent position. It is choppy. It is well off its highs, unlike Uber, which is near its all-time highs. So it has a lot of work to do. But for now, I'm not worried about Lyft. I do have a speculative call position, which may not end up working out. But my biggest interest is in Uber. All right. Also talking about automotive, or transportation, you could say, is O'Reilly Automotive, ticker symbol ORLY. I talked about this earlier. It looked like it was doing a nice recovery from this 200-day moving average breakdown and from its earnings loss back in October. Unfortunately, AutoZone had a bad earnings report earlier in the week, and ORLY dropped in sympathy 3.9%, and it's back to a bearish position below its 200-day moving average. And now we have both the 20-day moving average and the 50-day moving average converging in a downtrend, pushing down on the stock. I will have to get out of this position if it breaks below the low of the week. Again, just like Uber, I don't want to hang around to see whether there will be some late buying to recover the stock. I just need to get out of the way. All right, we're almost done. Hood, Robinhood Markets, ticker symbol HOOD. Robinhood looks like it's topped out. I've been looking for an entry to get into this stock, but now I am going to stand firmly on the sidelines. You could see how it had this fake breakout over 50-day moving average support and has been down the last 2 days. Big drop, 9% on Thursday, and another decent drop on 3% on Friday. Now, it's still holding the lows from November, so that's good, but I don't like the way it's kind of rounding out here. If I were to draw a line, I would draw sort of a purple curved line up here to really emphasize that topping action. But as you can see, I'm peeling back here. Overall, I mean, Hood has had an incredible run, and as long as it holds its 200-day moving average support, it's still going to be all good. And I am definitely a buyer at a test of 200-day moving average support. Now, going to end with JPMorgan, which is actually a negative note that turned into a positive. I mean, people really panicked, and JPMorgan dropped 4.7% after they made some slightly, negative commentary at the Goldman Financial Services Conference that the economic environment is, quote, more fragile. But buyers stepped in after the Fed announcement on Wednesday, and Thursday and Friday. Buyers have taken JPMorgan right back to near all-time highs. So I interpret this quick recovery as bullish. So it's signs like these that keep me hopeful that the year-end rally, even if it has to leave behind AI-related stocks, is still intact, and that market breadth will hold support at that downtrend line. Okay, thanks for checking this out. This is an education. I provide this as for educational purposes. Please invest and trade according to your own time horizons and risk tolerances. Please like and share this content so the algorithm knows what's up. If you love this content, please go ahead and subscribe to the channel, and you can get notified when I next post. I also have a lot of informative shorts, 1 to 3 minute videos that encapsulate a very quick look at the market. And also, if you have any questions or feedback, just go ahead and put them down below. I will check you out the next time. Thanks for staying here with me with the market